So I've been doing options for 12 years, and in that time frame, there's one single chart that has a 94% accuracy rate of predicting if a stock is going to go up or if a stock is going to go down. And we use this chart to figure out how do we allocate bullishly, how do we allocate bearishly, and how do we just simply make money in the stock market. And of course, this is going to be the exact chart that scaled me to a couple $1,000,000 through bull markets and through bear markets. Not day trading, not swing trading, not stressing about your portfolio all night long, just simply understanding how the market actually works and allocating when it makes sense to allocate. So, NVIDIA right here is the one that we're going to start on. We'll do this on a few different companies, and you're going to understand this crystal clear after we finish up this video right here. So, I have a 4-year chart right here of earnings per share loaded up. Earnings per share is going right here, and then we have a 5-year chart of NVIDIA right here. So as you guys know, the number one thing that moves the price of a stock in the long term is going to be what the profits are doing, the earnings per share. There's nothing else more important than that to figure out what a stock is going to do. So what we're going to essentially do is take this earnings per share growth line right here. We're going to make it a line, and we're going to plot it on top of this chart right here. And we're going to be able to see when the stock is above the earnings per share growth line, maybe up here on the tip of my cursor, the stock is going to be viewed as overvalued, and when it's below, the stock is going to be viewed as undervalued. And when it's over or undervalued, it's going to indicate to allocate options in a certain way. Okay, so let's flip over to a 1-year chart on NVIDIA. Percent basis is on the right, 1 year selected on the bottom. You can see that the stock went up 40% in 1 year, which of course is a very strong return. But how much did the earnings per share, the profits, go up in that 1 year period right there? They went up 64%. So the earnings per share went up more than what the actual stock went up. So if we go plot that line, it's going to look like this right here. We're going to go from there to 64% on the top right, and that is what we got for the earnings per share growth line. So notice a couple things right now. Do you notice when the stock is clearly below the earnings per share growth line that the future returns are pretty freaking sweet? And when the stock is a little bit above, the returns don't look too good if you ask me. Take a look at this on a percent basis. From below down here to the actual current share price right now, NVIDIA ran up 94%. But from the all-time high to where we're trading at right now, NVIDIA is down 10%. But notice how we were trading above the earnings per share growth line, so the future returns weren't too great. So maybe it doesn't make sense to be super bullish right there. But when we're clearly below the earnings per share growth line, maybe it does make sense to be very bullish right there. So when you understand where the company's at in relation to the profits, you could get a gauge of when you should be bullish or when you should be bearish. And that's where this whole thing of the 94% accuracy comes for this video. This chart is very, very accurately going to predict when a stock is going to go up and when a stock is going to go down on a longer duration basis. You're below, you're cheap. You're above, you're expensive. And the deeper that you go below that earnings per share growth line when you're allocating on a bullish way, the more margin of safety that you have in that trade. We all want to allocate to great companies at good prices, good valuation levels with very strong earnings per share growth. And when you plot the chart like this, you're going to get a very good gauge of where am I allocating at and where is this stock actually at right now in relation to the valuation and the earnings. So NVIDIA down here was clearly obvious to allocate. NVIDIA up here is clearly obvious to allocate because look at right now at the time of recording this video. The stock is clearly below the earnings per share growth line. And if we just want to go check this out on a percentage basis and see just how undervalued the stock potentially is, we can see that NVIDIA is roughly 14% below that earnings per share growth line. So right now is probably a good time to allocate bullishly. But we're not going to go allocate on a 1-month basis or even a 6-month basis. We have to allocate on a longer duration basis so that earnings per share actually has time to grow and the stock actually has time to follow that up and to the right. You can see there's a lot of volatility right here and a lot of bouncing around of the share price. There's not really much going on. So if you would have allocated bullishly right here when it went a little bit below, you wouldn't have really made any money just yet. But if you give it time for the EPS to grow, the stock is going to follow that in the long term. So right now you're probably like, okay, Brandon, I might get it, but I'm still skeptical. Let's just do it on another company right now. Let's load up the big bad Meta. Meta in the last 12 months, the earnings per share is up 24%. You could clearly see a dip in EPS, then EPS went back up. You could clearly see a dip in the share price, and then the share price goes back up. A little bit bumpy up here for earnings per share growth, but it is still going up and to the right, and it is still a little bit bumpy right now for what the actual share price is doing, but still on balance going up and to the right, kinda. So maybe there's an opportunity right here in Meta to allocate because earnings per share is going up faster than what the actual stock is going up. All right, so if we load up Meta on a 1-year chart, clicked it right down here so you could see it, and we look on a percentage basis, the stock is down 2.4% in a 1 year period. But remember, Meta, the earnings per share grew 24% in that 1 year period right there. So if we go plot that line and we go up 24% for Meta's earnings per share growth, I'm going to have to go up a little bit right there. You can see that the stock is clearly undervalued right now. The stock was clearly undervalued right here. Stock was clearly overvalued up here. So again, when the stock is above the earnings per share growth line, there's not a lot of future expected returns that we should expect to get from the stock. Because look at this. The stock from where it was at up here to where it's at down here is down 16%. But look at where the stock was at when it was deep below the earnings per share growth line. All the way down here to where we're at right now, up 35%. Not as big of a return as what it was on Nvidia, but still very, very strong. And when you understand that you got a 35% move right here, and by the way, I'm not saying that we're going to time the bottom perfectly. We just need to allocate to good companies when they're clearly below the line. Anywhere in this time frame down here, you're probably going to do well if you have a long duration basis. But you can see that right now, even at the levels that we're trading at, Meta is still 20% below the earnings per share growth line right now. So you caught a big move so far, and we still have a big move potentially coming on Meta. So right now, again, I am bullish on Meta on a long duration basis. But you could see on this 1 year chart, there's a lot of chop, a lot of volatility. They report earnings as stock tanks. There's going to be a lot of volatility on companies like this. So when you give a time for EPS to grow, like a year or two, and you allocate your option strategy in that way, you're likely to do very, very well. You're likely to make a lot of money in the long term. But a lot of people, they don't understand this line, and they don't understand that short-term market moves are very, very hard to predict because you don't have the bullish tailwind behind you of earnings per share growing, and you don't have the bullish tailwind behind you of getting in below the earnings per share growth line. A 1 week option, a 1 month option, the stock isn't going to have enough time to actually go and revert back up to the earnings per share growth line. So here's what I want to do. I want to do another company that I have a feeling, we're doing this on the fly right now, by the way. I have a feeling that this stock is going to be overvalued right now by quite a bit. We're going to look at the big bad Google. So you can see that Google in the last 1 year, the earnings per share went up by 34%. But what we're going to do is go plug in Google right here, and we're going to see how much the stock actually went up in the last 1 year basis right here. I didn't rig this. I'm doing this on the fly with you guys right now. You can see that the stock is up 75% on a 1 year basis. And again, the earnings per share is up 34% in that 1 year basis right here. So now let's go plot that and see what this really does look like for Google right now, and if it would make sense to go allocate in a very bullish way. If we go plot this, I'll move myself out of the way in 1 second, but we're going to go to 34% right here for Google. That is the earnings per share growth line for Google. So Google clearly made a really big move. Down here it was obviously undervalued, but over here it's clearly overvalued. Now, if we do this on a percentage basis, how much did the stock run up from when it was clearly below the earnings per share growth line? Let's say that you oh yeah, I'm going to go allocate down here. You look at this right here, the stock is roughly 11, 10% undervalued, whatever. What is that move going forward from right there? You can see the stock went up 90%. Really strong move. But if you take a look at where the stock is at right now in relation to the earnings per share growth line, the stock is roughly 22% overvalued because the stock went up a lot faster than where the actual earnings per share went. Now, I understand that price earnings ratio expansion and contraction has a factor with this stuff, but on balance, the stock went up a lot more than what the profits went up, and your margin of safety up here is much less than your margin of safety down here. We want to allocate bullishly down here, and we want to allocate bearishly up here. So let's go back to NVIDIA, and let's figure out how do we do stock options in the correct way to capitalize on this line right here and pretty much always try to make money on these trades when we do it. Because you guys know, I've been doing options for about a decade, and this line right here, it helps so much in the long term to know where something's at, to know how to allocate. I'm not saying it's the end all be all, I'm not saying it's the only thing that I look at, but there's a lot of value in this line right here, and it usually works most of the time. So this is a chart of NVIDIA. I zoomed it out a little bit. We're going to go for the previous year, which is where this line covers right here. And then we're going to go 1 year out from right there, and we're going to say that earnings per share is going to continue at the same pace. So we're going to go until the end of 2026, which is right here. And this is that earnings per share growth line continuing and going up and to the right. So here's how I'm going to allocate. When we look right here, I know it's kind of hard to see. I'll zoom it in a little bit. But when we look right here, what is the play to do right here on NVIDIA? Well, if you have shares in your account, but maybe you're long-term bullish because you know EPS is going up and to the right, maybe you're sitting on a huge capital gain and you don't want to go sell your shares, it could potentially make sense to sell cover calls right here. The reason why I don't usually like to do cover calls is because you have this tailwind of earnings per share behind you going up and to the right. So even if the share price happens to go revert back to the mean line of growth, which is the earnings per share growth line, you might have the problem of just rolling these cover calls higher and higher and higher and capping your upside with the cover call, because you're bullish with one hand by holding the shares, but you're bearish with the other hand by selling cover calls to cap your upside. So I'm not a huge fan of cover calls, to be honest with you. What I would do is maybe hedge a little bit right here, or just simply sit on your hands and do nothing. Now the big money is doing the bullish option strategies, selling the puts, buying the calls, buying the shares. So here is the play on Nvidia, or really anything when you feel like it's undervalued. Let's talk about down here. We'll talk about the current. We'll talk about the future. Down here, when it was clearly below intrinsic value, let's do this on a line right here. Let's say that you allocate somewhere around here where the stock is roughly 25% below intrinsic value. You're bullish. You want to go sell some puts. What kind of puts are you going to sell? I'm going to sell a portfolio secured put, not a cash secured put, as you guys know. The portfolio secured put allows me to stay fully invested and sell put options at the exact same time. The reason why I want to be able to do that is because if I'm bullish enough to sell puts, I should definitely be bullish enough to not have a bunch of cash sitting there doing nothing. I would probably want that cash deployed in this company or the NASDAQ or something to capitalize on an upside move. And a critical thing that most people mess up when it comes to options and capitalizing on where the earnings per share growth line's at is picking the wrong strike price and picking the wrong expiration date. If we go back to the chart, we see EPS is clearly going up and to the right. So what I'm going to do right now is I'm going to plot a theoretical strike price that we're going to pick. And we're going to do two different types of options. The way that I like to do it, where it's a 94% hit rate technically, and where other people like to do it, where they don't make money in the long run and capitalizing on this EPS growth line when things are over or undervalued. So right here, horizontal line to the right, this is going to be our strike price. It's 118.85, whatever. 118 is a strike price. What most people are going to do is, if they're smart, they're going to say, okay, the stock is below intrinsic value, stock is trading somewhere over here, I want to go sell put options. But what they do is they only do like a 1 month put. And you can see there's still a lot of volatility on the chart in this time frame right here. They're not really capitalizing on the share price going back to the earnings per share growth line, and they're definitely not capitalizing on EPS even going up and to the right. Like EPS is going up and to the right on a yearly basis, but in a 1 month basis, it's not really doing that much. So let's break this down how the math actually works. If you go sell a 1 month put, let's say that you collect $1,000 in premium, but if I go sell a 1 year put, I'm going to collect about $10,000 in premium, we'll just say. You get $1,000, I get $10,000. But here's the difference. When I go sell my put option, down here when the market is undervalued, I am able to go invest $10,000 down here when the market's undervalued. I sell the put, get the cash flow, go reinvest it. Meanwhile, you're selling puts month after month after month. Maybe you're a little bit early. Maybe you don't time the bottom of the market perfectly, which nobody's really that good to always time the bottom of the market perfectly. You're sensitive to this stuff right here. So when the market goes down, you get assigned to shares, and then you're nervous, freaking out, and you probably want to go sell cover calls and get rid of them, which is a huge problem. You're trying to sell cover calls down here, get rid of your shares when the shares are undervalued. The best thing is to hold on to those shares and let those shares rebound like they did right here. Earnings per share is always going to dictate where the stock's going to go. Stock clearly went up to the earnings per share growth line and then actually went a little bit above it. So up here is a time for covered calls. Totally not down here, guys. So the difference is when you do the monthly option, though, you're going to have to do your option trade 10 times in a row to make what I make in one trade. I'm going to generate 10K right here. You're going to generate $1,000 right here. So you're probably going to do good on a few trades. Like I said, maybe you get assigned right here. But then you're going to be forced to start selling some put options up here when the market's overvalued. And you can see when the market's above the earnings per share growth line, your future expected returns are not amazing. Again, hot right here, stock went down. Hot right here, stock went down. You don't want to have to do that. You want to be more selective and use this line to your advantage to capitalize down here and capitalize up here, in a bearish way up here and a bullish way down here. And the other thing that's probably going to blow your mind right here is how the margin of safety thing works and why this is much safer and easier for me to do the longer duration options when you factor in this earnings per share growth line. Let's say that you go sell puts right here. What is your margin of safety below intrinsic value, which is the earnings per share growth line, we'll say, and where your strike price is at? Your margin of safety right here is going to be roughly, we'll just say you're getting in 14% undervalued. Great, that's a pretty good margin of safety. But if you only do it for 1 month, you don't have time for the share price to rebound and EPS to grow. So right here is April 3rd of 2025. But let's say that I go till April 3rd of 2026. What is going to be my margin of safety right here? Going from there to right there. You can see that earnings per share growth line to 1 year out is 46% margin of safety. Much safer, much easier. I don't have to stress about the day-to-day volatility in the market. I know that if I allocate here and I give it a year or two, I give it 1 year right here, I'm probably going to be fine. And on top of that, the money that I receive in the cash flow, I'm going to go take that and reinvest it in Nvidia or whatever company we're doing this on because I'm bullish. I'm selling a put on the company. I should be bullish, right? So let's say I sell it right here. Look at the move that the share price would capture. What if say the share price theoretically ends up roughly right here? Share price went up 73%. Meanwhile, you doing your monthly puts, yes, you're going to capture a little bit of upside right there. But then once it gets up to this level right here, you're really capturing no upside and you're going to start dealing with assignment right here. Now, I know what you're thinking right now. Well, Brandon, the longer duration contract, you get no theta, the time value is not going to help you out. That is totally not true because when we really take a look at how stock options actually work and how they actually get priced, I'm going to flip NVIDIA to a 5-year chart right here, and I want to show you something. This is going to be obviously that April dip for Liberation Day tariffs. When we go take a look at this, when NVIDIA fell right here from peak to trough for that Liberation Day tariff dump, NVIDIA fell roughly 36%. What was the sentiment down here on the stock? Did anybody want to buy calls? Of course not. People are panicking seeing the stock going down. Does anybody want to go buy put options down here? Of course, everybody wants to go buy puts down here. So when everybody wants to buy puts, there's a lot of demand for those puts, and I'm going to go sell those puts for top dollar, and I'm going to run it 2 years out, maybe even 1 year out too, depending on how confident I am in the trade and how much time I want to really give it, and how much premium that I want to generate. So if I go run it 2 years out, sell puts to the nervous investor down here that's freaking out and want to pay top dollar for puts, that's exactly what I want to do. So when the share price does start to rebound, all these calls that I bought down here that nobody wanted, everybody starts to want them as the share price is going back up. People get FOMO, they get excited, they think the dust has cleared, everything is going to be okay. So they're willing to pay more for call options up here. But remember, the puts that I sold down here for bottom dollar when the world was theoretically melting and ending, everyone was freaking out. I sold them for top dollar down here because people are panicking, and then a share price rebounds. And yes, maybe this is only a 3-month move right here. But when I was selling puts on NVIDIA down here, guys, I was selling puts and I did them 2 years out and I closed them out just a few months later and I made roughly 70% on those sold puts. I held them for 3 months out of 24 months and captured the majority of the profit, 70% out of 100% for a sold put. Like, that's freaking good if you ask me. And a lot of that is because everybody wanted puts down here. As the market rebounded, nobody wanted puts up here. Everybody wanted calls up here. So I'm capitalizing on the sentiment factor right here. I'm obviously capitalizing on a share price going up, but theta obviously helps me a little bit. It's 3 months of theta out of 24 months. It's a little bit, but the majority of the money that I made right here is share price appreciation, getting in below intrinsic value, and the share price rebounded, and then the sentiment flipped. That is a critical thing right there. Okay, so quick summary. Plot the earnings per share growth line. Be bullish when things are undervalued. Be bearish when things are overvalued. And extend your time horizon to likely 1 year or longer. You're going to generate more cash flow, not have to stress about the day-to-day volatility. You're going to be more reproducible with this stuff in the long term. When you sell the longer duration put, you're going to generate more cash flow when it makes sense to do it. When the market is cheap, you sell the put. Don't you want to go reinvest that big cash flow, the 10K cash flow, instead of 1K cash flow when the market is down and when the market is cheap? That's exactly when you want to get in and do this stuff, guys. And it doesn't require timing the bottom of the market perfectly. It does require timing the bottom perfectly if you do short duration contracts, which I never do. But long duration contracts, it's just so much easier and you have so much more flexibility with this stuff. That's why my win rate and my hit rate and my ROI since before COVID has been smoking the market in the long term. So if you want to watch a really good video more in the portfolio secured put, watch this video right here. It's going to help you out a lot. I'll see you guys there.